Welcome to this Killik Explains Finance video. This week, I'm going to answer what seems like a fairly obvious question to ask, which is why stock markets have risen over the long term. No one can forecast the future, but the future is looking reasonably rosy if we look at the past and we think it's some kind of guide, which regulators force me to say it may not be, but let's take a look at how well stock markets have done and try and explain it. Now, I'm going to cram a lot of economics into less than 10 minutes, so I will be skimming and I'll give you a couple of links at the end for more information. Okay, so the background to this. First of all, there is no doubt about it. As I stand here today, let's say in late February 2019, the picture is upward. Now, stock markets do not go up in a straight line. They wobble all over the place. We've had dot-com crashes, financial crises, but that trend is reasonably clear. This is total returns from the American stock market, the biggest one in the world, which tends to drive others, certainly has an influence on the UK market. S&P 500 is a total return, this chart you're looking at, and it takes it back to from when the data is available in 1988. Now, if you're thinking, well, that's a pretty pink line, sort of wobbling up, I can see broadly speaking we've got some growth there. Remember, the future could be different, but this suggests that stock markets do rise over time. If you want a number on that, there are various ways of looking at this, but from 1871 to 2018, so a much longer period, Schiller reckoned that the US stock market total return has been something like 9.01%. That's an average, quite clearly, fairly healthy one at that. So what I'm asking is what's underneath that? So let's drill down, let's say. Now, I'm going to condense a lot of stuff into some short, pithy points here. So about 4% of it is earnings growth. Where that comes from, we need to explore in just a moment. More than that, believe it or not, is dividend reinvestment. So we need to take that on in just a moment and say what's going on there. How can that actually have contributed more to the 9% number than the thing on the left, earnings growth? And then we've got multiple expansion, not to be forgotten about. Now, I've covered that elsewhere, so I'll give you a reference to that. I'm going to focus on the two on the left just in a moment. So let's take a look at these in turn. Earnings growth, first of all. What is underpinning that 3.99%, that consistent 3.99% on average? So why do earnings grow? All right, worth asking the question, especially if you're thinking, will they continue to grow and at what pace? Now, US GDP growth, nominal that is, has been around 6.36% from 1947 to 2018. So there's a growth number to take a look at. So what's underneath the bonnet there? What underpins that growth number? Now, stock markets and economies do not move together at the same time. I've done other videos on that, but nonetheless, that's where we're going to start hunting down what's happening to drive stock markets up over the long term. So, population growth, according to the Fed, has added 1.16% to nominal GDP. And if you're an economist, you'd be thinking, what rate could we expect that to continue, if we expect it to continue? Productivity gains have added around another 2%. This is to get back up to the 6.36%. And then inflation has contributed around half of it. All right. So let's take a look at each of those in turn. Population growth, first of all. Now I'm condensing masses of economic science into just a few points here, real bullet points, link coming up at the end. So labour is often the costliest element of production, around 60% of the value of US economic output. All right. Growing populations tend to generate more eligible workers, and they earn and spend money to support both their families and their lifestyle. And basically, as they move up the chain, if you like, their lifestyle requirements become that much higher, as do those of their families. So there's fact number one. You can see that, summarising a lot into a short space here, demographics are a key driver of that GDP number I mentioned, which itself underpins a lot of that long-term stock market growth. Number two is productivity gains. Now, this one is perhaps slightly less obvious, but you'll see what I mean when we break it down. So productivity is all about doing more with less. It's not just about having more eligible workers available to work, it's about them being more productive in work. And that's particularly important for mature economies. All right, they need to be good at productivity gains. So a lot of economists spend a lot of time looking at, for example, is productivity increasing or not in developed economies. Now, where does it come from? So there are efficiency gains. You can break it down as two, which allow the pace of production to increase. Then you get value creation when you get a fundamental piece of disruption. Now, if you want an example, what I'm doing could qualify. So if I get faster and better at delivering key educational messages, arguably I'm ticking the box in the middle, efficiency gains. You can learn more in a shorter space of time. if someone then creates a way to basically magnify Tim Bennett, so I don't have to go to classrooms and seminars to give that message more efficiently every single time, hang on a minute, that could be called YouTube or the internet, then you get arguably a game changer. That actually changes, no matter how fast I go and how good I am, how many people can take advantage. So that increases productivity on a much bigger scale. And there's a simple example of how you get the two components, and either one of them can add to overall productivity. So economists spend quite a lot of time measuring or trying to measure whether productivity is increasing and how fast. Then you've got inflation. Now, central banks tend to like a bit of positive inflation. You might have noticed that we don't like deflation. Reminder of the reasons in a moment. So the result of cost increases, usually labour and raw materials, those tend to rise over time. You tend to want a pay rise at the end of the year, not a pay cut, let's say. That encourages consumption, or rather inflation encourages consumption and reduces debt burdens. So why? Well, essentially, if prices are rising, people tend to want to spend now rather than later, because if you wait, whatever it is you're trying to buy will get more expensive, and reduces your debt burdens. If you've got a mortgage, inflation can be quite a powerful way to erode the real value of it. What do I mean by that? Well, the rule of 72 says that if inflation is, say, 4%, and you divide 72 by 4, you get the number of years, 18 in that case, that it'll take to halve the real value of a mortgage, roughly speaking. So you can see that over the long term, inflation is quite a powerful tool. It encourages people to spend, that's the theory, and it also reduces debt burdens. Hence, central banks tend to try and keep inflation positive, but not massively high, not hyperinflation. Now, why is dividend reinvestment so important? So we looked at earnings growth. We looked under the bonnet and said, okay, we need to explain something about that 3.99%, but what about this number? Dividend reinvestment, 4.5%, a bigger number contributing to that overall total of 9 from Shiller's data earlier on, and then multiple expansion of a half. So that middle number is now pretty important. How can it be? This isn't actually wealth generation per se in the way this is. So what's going on? How can simply reinvesting dividends, which are the result of companies making earnings, into the market create that value? Well, the answer is efficient allocation of capital. So, simple example, if company A is a $5 billion firm, growing at 20%, so maybe it's some kind of tech firm, let's say, and paying no dividends, and it's in the same little pool in terms of the stock market as company B, which is double the size, but only growing at 3%, maybe it's an established utilities company, for example, and therefore offers a yield of 3%. I'm making up the numbers here. So, no dividend, 3%, twice the size of this one. So, the question is, if company B pays its dividend as normal, and that's reinvested automatically, where will it end up? And there's the answer. B's dividend of 300 million, that's 3% of 10 billion, will be reinvested 1/3 into A and 2/3 into B, pro rata. And that's an efficient use of that capital, because remember, A is the firm that's growing faster, growing earnings faster. So the market is, via this mechanism, automatically reallocating capital to A. Now, multiple expansion, I'm going to keep this very brief because I cover it in much more detail in another video, and I want to keep this one short. So that was the final bit. Now, the contribution of multiple expansion will depend which data you take, but according to Shiller, that was 0.47%. All right, so in that context, basically I just urge you to see the 3 key drivers of stock market returns, which includes a bit more on multiple expansion as part of the Killik Explains series. But it's basically all about the market's expectations about future levels of earnings growth. That will influence the total stock market return. If you want to know more, because I've covered an awful lot of ground, there's an awful lot of science behind some of this stuff that I've been talking about, then there's a good link, factorinvesting.com, why do markets go up? If you want to see some of these arguments and a bit more data behind them. And if you'd rather just ping me, on the other hand, then as usual, it's editor@killik.com. And basically, if you want to watch videos, including the one I mentioned earlier, a couple of slides ago, killik.com/learn, and I'd head for the shares tab.